Hello number-curious friends, welcome to the channel where we talk accounting and finance. Today we are going to learn one of the most important concepts in finance, net debt. This is a metric used by investors, banks, credit analysts, management teams. And once you understand it, you'll start seeing the financials of the companies differently. What is net debt? Net debt measures how much debt a company has after considering available cash. The basic idea is simple. If you have loans, but also cash in the bank, you could use some of that cash to repay debt. The formula is quite simple. Net debt equals borrowings less cash and cash equivalents. Both borrowings and cash we have discussed in detail in separate videos. Links will be in an upper right corner, check them out. Simple example of the net debt calculation is loans of 100 less cash of 30 gives us net debt of 70. And let's agree that we will show liabilities in the net debt schedules as negative numbers and cash items as positive. I just like it this way better. But you will also see the other way around where debt is positive and cash is deducted as negative. So, in our example, even though total borrowings are 100, the company's real debt burden is only 70. Therefore, looking only at total borrowings can be misleading. Before we move on, if you find our videos useful, please take a moment to hit a like button, subscribe to our channel or leave a comment. That's very important for the channel, and thank you for being with us. Imagine two companies. Both have reported financial debt of 1 billion. But one has almost no cash at 50 million, while the other has 800 million in the bank. The first one will then have a net debt position of 950 million, while the second one 200 million. This makes a difference. And these are very different risk profiles. That's why analysts focus on net debt, not just debt. Now, let's look at what normally goes into the calculation of net debt. In the financial debt, you would typically include bank loans, bonds, notes payable, overdrafts, and sometimes also finance lease liabilities. In the cash, you normally include cash, cash equivalents, and highly liquid short-term investments. Sounds quite simple, right? But here is where things get interesting. Real life is rarely simple. Sometimes companies have cash that cannot actually be used. Examples may include cash trapped in foreign countries, regulatory restrictions, collateral accounts, loan covenants requirements. This cash is called restricted cash, and if cash cannot realistically be used to repay debt, it is normally excluded from the net debt calculations. Let's have a look at an example. Total cash of 100, restricted cash of 40 means freely available cash of 60. Net debt uses 60, not 100. Another big discussion for the net debt is lease liabilities. Under modern accounting standards, especially IFRS, leases are recorded as a financial liability and by default included as debt-like obligations. But in practice, the approaches to the treatment of leases differ. Sometimes they are included as debt because they are future payment obligations and are not part of operating expenses in EBITDA. Sometimes they are excluded to focus on financial debt. We will discuss the topic of leases in later videos. It's an interesting and an important one. All this means net debt can vary depending on methodology. So, always check the definitions. It may also happen that companies have more cash than debt. For example, debt of 50, cash of 120 means net debt of 70. Now we have a positive net debt. This is called a net cash position. Now let's pause for a moment and think. We have been discussing borrowings as debt. What else, in addition to borrowings, can be part of net debt? In real-life analysis, not all debt is clearly labeled as borrowings. It is often adjusted for so-called debt-like items. For example, lease liabilities are future payment obligations and are often treated similarly to debt. Pension deficits may also behave like debt because the company will need to fund them in the future. Factoring liabilities, deferred payments for acquisitions, litigation liabilities, supplier financing arrangements and so on can also increase financial risk, even if they are hidden in other balance sheet items. That's why professional analysts often calculate an adjusted net debt. Same relates to cash. Net debt is also adjusted for so-called cash-like items. These may include cash equivalents, treasury bills, money market funds, short-term deposits, loans granted. Highly liquid instruments like treasury bills or money market funds are often treated as cash-like because they can quickly be converted into cash. But restricted cash or trapped cash should then also be excluded. For example, some cash may be legally blocked, pledged as collateral, or held in countries where transferring money is difficult. So, before deducting cash from debt, you ask one key question: can this cash realistically be used? This is why adjusted net debt can differ significantly from the simple formula. For example, a company may report net debt of 400, but after including lease liabilities and pension obligations, excluding restricted cash, and including investment in bonds, adjusted net debt can be 600 or more. This is also why reading the notes to the financial statements is critical. The balance sheet alone rarely tells the full story. That can also materially change leverage ratios like net debt to EBITDA, which is one of the most important ratios in finance related to net debt. Why EBITDA? Because EBITDA is a proxy for operating cash generation. For example, with a net debt of 300 and EBITDA of 100, the ratio is 3. This means the company would need roughly 3 years of EBITDA to repay debt. The higher the ratio, the higher the risks are. Net debt should also never be analyzed only once. Trends matter. Here you should ask yourself: is net debt increasing? Is EBITDA growing faster? Is the company deleveraging? A company can survive high debt if profits and cash flow are growing. But falling profits and rising debt? That's dangerous. Net debt also connects directly to liquidity. A company may have low net debt, but also very little available cash flow, or vice versa. That's why analysts also look at maturities, refinancing risk, interest rates, covenant pressure. Different industries may have different net debt profiles. Consumer goods companies like Unilever or PepsiCo normally will have stable cash flows, moderate leverage, predictable debt servicing. Tech companies who bill their customers in advance like Nvidia could have huge cash balances and sometimes net cash position. Capital-intensive companies like Tesla will normally have more volatile financing needs, large investments, debt linked to growth. What are typical mistakes beginners could make? Using total debt instead of net debt. Ignoring restricted cash. Mixing lease liabilities inconsistently. Ignoring off-balance sheet obligations. And looking at 1 year only. And that's the snapshot of the net debt. In the next video we will look into debt-like items. If you have other questions, post them in the comments below. Thank you for watching. If you enjoyed this video, hit like, subscribe and ring the bell so that you don't miss the next one. See you soon and keep those debits equal to your credits.